All right, good afternoon. Good afternoon. Okay, I'll take a short while just to take advantage of the earlier paper by Rogers and just build on it, mostly around the background and a bit of, you know, the references that we've looked at. So our paper is titled Credit Guarantee Schemes and MSMEs. And in this paper, we are looking at farm level sort of analysis. So we have one specific credit guarantee scheme that we've looked at, and we'll probably just look at some of the info that you're getting from that data and see what we can infer from it. Obviously, as introduced earlier, MSMEs are a key component of this economy. Just looking at about 15 million, people employed in this sector, about 30% of GDP from this sector. Then looking at, although slightly dated, that's KNBS establishment census done around 2017. That sort of puts the MSME enterprises at about 72%. So that tells us that they're quite important into the sort of registered enterprises that we have. Then lastly, which is also more important, we've seen quite a number of innovative ideas and also products come out of this portfolio or this segment of our economy. Then mostly in this study, we've narrowed down around the formal classification for MSMEs by the Ministry of, by the government. By way of introduction, we obviously have high perceived and sometimes actually real risk around this portfolio. Then we've also had the case for, presence of collateral, but that collateral is either inadequate or not quite acceptable to most of the, FIs, that's financial institutions. Then lastly, we've also had the issue of, adverse selection and moral hazard. And that sort of puts us to, a de-risking mechanism from which we've seen the government lead at the front, which is just sort of to put in some third-party credit risk mitigation mechanisms. So far into these mechanisms, we've seen the government-backed guarantee scheme, a seed capital of about 3 billion, so far disbursed just for 4,000, slightly above 4,000 loans and slightly above 6 billion. And that means that, well, not to the scale most of us would have had comfort with. And that scheme has also given us the impression that we have about 73, borrowers that are new into the formal financial system. Then on the private sector, we've had a couple of DFIs, that's development financial institutions, roll out several guarantee mechanisms. And one of the guarantee schemes that we're looking at actually borrows from one of these DFI credit guarantee schemes. So far, what we've seen is that despite existence of this credit guarantee mechanism, and if you look at the government one, dates back to just slightly after COVID, late 2020, we've still seen MSMEs continue to get constrained with regard to credit access. So one at this point would ask whether this has improved credit access, and also looking at the numbers that we've seen, especially from the government-backed guarantee scheme, the numbers are not as rosy as we would have liked. And also around 2021, we saw KBA come up with a survey which indicated that still above 50% of the enterprises are reporting constraint with regard to accessing bank loans. And most recently, if you look at credit data from the regulator, one gets the sense that credit growth is still quite low. If you look at media, that's June, about 2.2%. And if you look at the line for the trade segment, which is mostly, call it 80, 90% SMEs, credit growth there year on year as at June was just about 3.7%. And that means that there is a real challenge with regard to access of credit for this segment. And just comping most of the literature, which bears evidence across, especially Asia, where this sort of sprang up much earlier, and also South America. Evidence is still inconclusive regarding whether credit guarantee schemes actually enhance credit across most of the key markets. So for this study, our objectives have been as follows. One, we just wanted to examine the performance of this specific credit guarantee scheme with regard to a couple of components. Secondly, we've also sought out to determine whether the credit guarantee coverage ratio actually leads to less default or even less probability of default. And we've also enlarged this to cut across the specific sectors that most of the borrowers are coming from, just to see whether does this probability of default differ across agriculture, manufacturing, or even the other sectors. And hopefully our dream is that this will be useful for the review of a couple of credit standards across most of the key lenders in this portfolio. And the other thing is that we also contributing to a bit of empirical evidence, given that in this market, this should be one or among the first studies to look at very farm level data. And given the discussions that are ongoing with regard to the greater credit guarantee scheme question, we hope that these findings will help in the redesign of these schemes, especially on the government side or even for the DFI side. Then just briefly on the research methodology, the way we did this is we looked at performance. In this, we measured the utilization level and also the portfolio quality, just looking at the data as it is. Then to look at whether, getting on board a credit guarantee scheme actually improves credit quality. We used a probit model to analyze the probability of default, and therein we controlled for the farm level characteristics and also the amount of credit that was disbursed. And we also have data across, the purpose of the loan. We also controlled for that. And specifically, we used data for very close to 2,400 MSMEs. That's 2,398 MSME borrowers. And that was done for the period, 2022, January to February this year. And just looking at the model choice, this enabled us to, look at the unobserved characteristics or behavior of the borrower. And also, the error term did us good in terms of that analysis. So looking at the findings, just briefly, then we can go into the Q&A. Looking at the performance, we have obviously these close to 2,400 MSMEs that were able to access credit above the available collateral. And secondly, if you look at the sort of repeat customer framework, about close to 17%, that's 16.35%, were repeat customers for this access. And that means that the credit guarantee scheme points to improved access for these borrowers. And most of this was actually just for working capital financing. And then if you look at the portfolio quality, we have about, in terms of count, about 198 MSMEs that defaulted. And if you look at the value there, you get a figure of 8.3% being in default. Comparing that with the mainstream or the industry level, SME type of default rate, mostly just looking at the trade portfolio, which is mostly, the wholesale and also the retail and the repair guys. For the industry, that's about 21% as at June, and that means that performance in terms of portfolio quality under this scheme is actually much better than the average SME level type of performance. Then looking at the second objective, which is just to look at the impact of this credit guarantee scheme, we noted from the analysis that about looking at the probability of default, about 30.2%, is the figure we got in terms of the probability of default increase, in the credit guarantee coverage ratio. And that means that there is a bit of moral hazard in that bit, and although that was quite insignificant. And just to display the overall numbers, if you look at the first column, that's the coverage ratio, disbursement amount, and also the age. For model 1, it tells us that increasing the coverage ratio, add that probability of default, although it's not significant, both at 1% and also 5%. However, we noted high moral hazard effect across some of these sectors. For example, if you look at model 2, which is model 2, which is agriculture. If you look at building and construction, which are mostly SMEs around the supply chain, ballast, some queries, and also transport sector within the building and construction. That was also high. And the other one is model 6, which is manufacturing, which touches mostly around the supply chain with regard to transport and also distribution for some of these manufactured products. Age also gave us, some interesting results, and it indicated that overall, which is model 1, the probability of default reduces with farm age, which was expected. However, that was different for two subsectors. One is agriculture, so age was, was not in line with the overall model, and the other subsector was tourism. And we think that these results sort of denote the high variation with regard to seasonality in these two sectors. Because if you look at agriculture and tourism, most of them have significant seasonality, which is in most cases, if you look at weather, that's quite outside, the purview or of the farmer, whether it's a large-scale farmer or not. And secondly, if you look at most of the tourism operators, be it restaurants or hotels, if there's COVID, then they have nothing to really do about it. And the other thing is that any external shocks are usually, cutting across both the small and also the bigger enterprises for these two sectors. Then this sort of gives us a couple of policy recommendations. One is that we see value in these results, providing, some incentive to the lenders to either enhance the partnerships or even the guarantee partnerships that they have with various institutions, given the value in this one, which is improving access, and secondly, with regard to lower probabilities of default when farms are covered under a credit guarantee scheme. Then as we get into the season of reviewing some of these credit guarantee schemes, then we expect that this input will also be useful, especially looking at the results that we get across the sectoral view. where it tells us that we need to go beyond the vanilla type of credit scoring model for the credit guarantee schemes, and maybe tailor it across the various subsectors, given the behavior that we've seen with regards to the probability of default. Then lastly, which is on the results that we get with regard to age of the firm, we think that this also sort of puts emphasis with regard to financial institutions training on entrepreneurship, or even other trainings that they do offer the young MSMEs in this country. Thanks. I'll pause it there and invite the discussant.
So the discussant of this paper is yours truly, and I would want to keep it brief in the interest of time, so that I know a number of other comments. I'll convey them directly to the authors, but ideally just want to emphasize on a few things that are coming up, even as we see from the study. I think the study pursued two main objectives. The others, of course, are beyond this, but ideally around the impact of coverage ratio as a feature of credit guarantee on default probabilities, and the differences in probabilities of defaults across sectors, whether we can see evidence across sectors. But it calls on us to really start thinking about, is there value in using aggregated solutions, or there is value in disaggregations? Because we are now starting to split hairs in terms of whether probabilities of defaults differ across sectors. Soon we'll be seeing, does it differ across products? So they always say they don't want to say the devil is in the detail. The angel is in the detail, in terms of, by splitting, we start to see some new insights that actually are being generated. And I want to thank the authors for this paper. The fact that even moral hazard itself can differ across sectors. So the behavior of certain customers within a particular sector can be different. Is something profound, because it means, is there a sharing of information within a sector, particularly those that, say, in the agriculture sector? Do farmers collude to behave in a certain way? Or is there learning from one farmer to another? Is there learning from one player in the tourism industry to another? So when you start seeing these trends, then it means that the way we treat a particular sector starts to differ when we are addressing this. And this being a critical component of credit guarantee scheme, it actually informs the design of credit guarantees. We start to think about design features, start to think about product and sectors, even as we design this. So if we now get to a point where we can say there is no one size fits all, we must disaggregate and actually look at the detail, because that's where we see a lot of insights that is coming. And it speaks very well to the issues around, even today as we talk about pricing, we are now centering it, not saying that it will never be on the product, it will be on the individual. So getting back to the individual and assessing the individual on their own standing, it's indicative, because if we can see differences across sectors, perhaps even if somebody was to look at individuals within a particular sector, you may actually start to also see some interesting trends in terms of differences from one individual to another within the same sector. As we group them in the sector, we see differences. As we disaggregate them to specific individuals, we may see differences. So the individual has become the point of pricing, the point of focus, if you want to look at it. Older firms behaving differently with regard to younger with regard to probabilities of defaults? Is there learning that happens over time that we can start to take advantage of? And then if it is learning, at what point, what is the pivot point? Beyond what level of experience does one start to think about not defaulting on a particular facility? So all this start to indicate that there are behavioral issues, and I want to revisit a paper that once I think was published by Josiah and Jared before, about biases, behavioral biases that start to be seen within a particular group of individuals. Now we start to see some differentiated characteristics from one sector to another. And of course, these are trends that would be keen to know, so that we now know we don't use the same paintbrush for all. There is need to start considering solutions that are informed by detail, and therefore that then becomes very, very critical. So I commend the authors for this, for shedding a lot of light on this and alerting us that please, as we consider solutions in the market, there is no one size fits all. There is merit in looking at detail, because there are a lot of insights in there. And of course, once we appreciate probabilities of defaults within a particular sector, and then we start now to design products based on that information. And therefore, we don't suffer losses as a result of applying blanket product features across the different sectors. So I thank the authors for bringing us this paper, very insightful. I'd encourage all of us to read it as it gets published soon. And of course, the rest of the other writing details, will make them available to the authors as we go along. But I want to invite comments. Finished with the discussion part. Now I start the chairing part. Invite comments on the paper. I see Jared's hand is up. Okay, you can take Jared and then.
Thank you. I wanted to speak with the music in the background, but I think now I just have a couple of comments that actually run through the two papers, because the two papers are related. The broader one is with regard to the assumption that the assessment you're making on the credit guarantee schemes is that the way they're fit for purpose. Both papers have not made any deliberate endeavor to actually question whether the design issues of those credit guarantee schemes make them useful or not, depending on which corporates they want to target. And that is why I think the first paper by Mwalimu spoke to design issues, but didn't go into the details that one could have expected on what to think about in design. My comment there will be, you look at design beyond the coverage, how much is covered. Because when you look at design beyond coverage, you bring in other interesting dimensions that then can allow you assess effectively the credit guarantee schemes. By here, I mean the ownership structure of the credit guarantee scheme. If the credit guarantee scheme is 100% government owned, then that is basically a taxpayer insurance of credit. And that has a dimension to moral hazard, because the moment it's 100% government, any borrower will say that this is our money, pesa yetu, so they may not necessarily be. So that's a design issue. The other design issue is around the participation of the lenders themselves in ownership of a credit guarantee scheme. The conversation you had in the morning is a design issue. And what does that mean to the performance of the credit guarantee scheme? I think that's an empirical question. So design issues are really very critical here. The second comment is around, the nexus between the credit guarantee schemes and the kind of expectations that the financials have on whether they're getting any capital accommodations if they take, guarantees, meaning how much capital hit you take when you have a guarantee, whether that guarantee is 100%, 50%, whatever it is. Now, I want to stretch that conversation slightly further by saying that, yes, you may expect some things around capital if you have a guarantee, but on the liability side of the banks, you only have capital. You also have deposits. Is there a way in which expectations on what the cost of deposits is linked to a credit guarantee scheme? Why I say so is because the reason why you want to provide credit guarantee is so that you don't have either people not lending to SMEs, or you don't have SMEs building into the non-performing loans in a manner that goes beyond financial losses to the banks, but also potentially to having an implication on financial stability. So in that case, therefore, just like credit guarantee is an insurance on the asset side, we have deposit guarantees. And you may think that there's no relationship between deposit guarantee and credit guarantee until you start thinking about what happened recently in the US, where some banks collapsed, and now the government had provided blanket assurance on deposit side, even though they have credit guarantees. So I think broaden the conversation further to look at how credit guarantee is on both sides of the balance sheet of banks in terms of consideration and conceptualization. I think those are two comments I wanted to make, so that at least as you think about these credit guarantee schemes, we don't assume that they are fit for purpose simply by just looking at what they are and how much they're able to leverage. Thank you.
Thank you. There are 3 hands.
Okay, thank you. I'm Kudachi Sango from Stanbic Bank. One of the things maybe we need to think through and interrogate is the relationship between credit guarantees and probability of default. So in as much as the outcome may be statistically significant, is the probability of default more of a guarantee or collateral play, or more of a cash flow play? Because that's why you find, even where collateral is availed, and then you overlay with a credit guarantee, you may not see, much of a significant kind of difference in the way probably accessibility to credit. Because probably before one is lending, is looking at the cash flow play, which plays much significantly to the probability of default, more than a reduction of loss given default, because that's what creates now the moral hazard bit. If someone is saying, okay, I may default on this, and they may claim from the insurer or from the guarantor, probably that brings the behavioral aspect. That's not desirable, but the assessment before the guarantee comes into play, it's more of a cash flow play than probably a collateral and a guarantee play. So that's why you'll find accessibility continues to be a problem, as long as one is not doing security lending to reduce loss given default, but one is looking at cash flow play to reduce probability of default.
Thank you. Thank you, Dan.
Yeah, thanks. So my name is Dan Tandas from Tanzania Bankers Association. Yeah, the finding that really interested me was the fact that the higher the credit guarantee coverage ratio, the higher the probability of default. Of course, the analysis show that the result is insignificant across the board, but it's still important, as the previous speakers alluded to. Now, the question is, you highlighted about the rationale of disaggregating the coverage ratios and how we go about ensuring the effectiveness of these credit guarantee schemes. I wonder whether the authors found that whether there is an optimal credit coverage ratio, the general optimal level, but also whether through the data it can be established whether there could be disaggregated optimal coverage ratio for these credit guarantee schemes. But the previous paper, speaking about the design issues, talked about the rationale of having independent, sort of adding an independence feature to the governance structure of these credit guarantee schemes. I wonder whether the second paper find that that's also very important, that the governance structure issues of these credit guarantee schemes in our markets, and whether they're best practice in other markets with regard to how these credit guarantee schemes can be governed well. Thanks.
Thank you, Dan. There was a hand up by Caroline.
Thank you. My name is Caroline Kariuki from Strathmore University. So I wanted to kindly ask Anthony, actually the question is linked to what has been asked, but I didn't quite understand the methodology part, perhaps how you came to that conclusion as to that relationship between the credit guarantee coverage ratio and the probability of default. And also, kindly, maybe according to you, why do you think that the default risk reduces with an increase in the loan amounts that are lent out? And then for Dr. Rogers, I had also asked him this question earlier, but because he mentioned that for institutions or SMEs that maybe have collateral and also get the credit guarantee, that doesn't really reduce perhaps the loan amount, or or they don't really benefit much, even if they already have collateral. So I wanted to ask, do you think with the new loan pricing model, like with the introduction of Kesonia and how there's now a focus on the, individualized, perhaps the premium K being more individualized, do you think that will help transfer those benefits to MSMEs when they have their own collateral and perhaps or also the guarantee as well? Thank you.
Thank you. I think we'll go to the authors. Do you want to comment on the same? We can start with Rogers, the other side. Then we come to David and Anthony and Samantha. Sorry, Mwalimu Rogers.
Okay, thank you. Maybe let me quickly respond to Dr. Caroline's question. Indeed, the expectation is the two should complement one another in the sense that if you have collateral and on top of that layer you have you are guaranteed, you should be able to get a low rate. The data that we had didn't seem to agree with that hypothesis. Our quick thinking could be that banks are not passing the benefits of the guarantee to the borrower. But then again, as I mentioned earlier, I do not want to, explore that conclusively because of the kind of data that was available. I remember the discussant mentioned issues like endogeneity. So there is a level to which we can put our consideration on the empirical results. But that is probably if we get more data to understand the characteristics of these firms, perhaps the interest rate, the other considerations that banks are putting in, which we are not controlling for. So probably, that's a good question, but as we get more data, it would be important to really dig into why that is not the case. Because individually, the collateral and the guarantee, individually they seem to reduce, but when we interact, then that effect, so which means probably banks are looking at collateral more than the guarantee, and that's why we do not see the interaction being quite, it's over, you know, it's not, the guarantee is not adding, it's not complementing its the collateral. Okay. I don't know if there was any other question for me, but yeah, that's the one I picked directly.
Okay, I think it was about a further discussion around the design issues would be helpful in terms of the sensitivity of the results that we are getting to design issues, whether we can, what can we learn for design based on the empirics that we are coming through. But I guess as we refine the comment to take home, as we refine the empirics, then we link it up to design issues that would come up for guarantees, because I think that would be very topical and also very timely around this time when Kenya is considering incorporating a credit guarantee company that is solidly designed so that we expect this to be an input paper. So thank you. I think we would go to the NCBA team for any quick feedback on the comments that have come through. Mike, please, Mike.
Yeah, I think two issues to respond to. I think much of the issues were on comments on improvement around the issue of the design. And also what Jared mentioned about the issue of the deposit guarantees and how they sit in the bank's balance sheet. A response to Dr. Karo about the issue of the default, the effect of the default probability. That is the loan size. The findings is that as the loan size increases, the probability of default also increases. Now, let me clarify this. I'll tie this with the question asked by the colleague from Standard Bank and also from Tanzania Bankers Association. In the paper, and we know there's that confusion, when it mentioned the probability of default, we don't actually refer to the probability of default as we know from the credit side. That size you get from the bureau or credit scoring. The probability of default here is a binary outcome. So given the data that we have before you run the probate model, if the MSME has ever defaulted, it takes a value 1, otherwise 0. So the probability of default here is the one which is being estimated by the probate model. But I know in this room, the bankers may confuse that with the probability of default as the one that we get from the CRBs or the credit scoring model. So we need to clarify that. So we are not using the probability of default from the credit models or the bureaus. So here we get the data. If the firm has defaulted, it takes a value 1, otherwise 0. So it's a binary outcome. So that takes me to the response to Dr. Karo Kariuki. Our finding here is that as more amounts of loans are dispersed, then the probability of default or the probability that the firm will default increases, which could be explained by two issues. One, of course, when you have a higher loan, then in case of any shock, then you have a higher chances of defaulting because you are high installments as well. But also, if you look back into the data, for those, this could be explained by, if you look at the loan disbursement vis-a-vis the coverage ratio, you'll find that for the firms which are having the firms that you're using, the 2,398 firms, the firms which have high disbursements also have a very low coverage ratio. And therefore, you find that much of this exposure is being covered by the bank, or the bank is more exposed, it takes a higher risk on that. And therefore, in case of any shock, then the same is likely to apply.
Okay, thank you for that feedback, and of course the rest is what you can carry into incorporation into the paper, including whether we can see optimal coverage ratios within the guarantees that we are designing, and the linkage around, I think it was about a further discussion on the independence element in the design issues for Rogers. So thank you very much.